We're going to do two things in this module. First is we're going to review the types of mutual funds that exist, and we've done that before, but we're going to review those one more time. And then we're going to specifically focus on one type that we haven't talked about, and that's asset-backed securities. The types of mutual funds that exist out there, and again we've talked about these already, is Treasury, municipalities, municipal bonds, and again municipal bonds cover any entity, state, local government, city, and their affiliated organizations like water districts. That would fall under municipal bonds. The key part of that's different than corporate and treasuries, at least from an investor standpoint, is the fact that municipal bonds are tax exempt in many cases. We also talked about corporate bonds, which are offered by corporations, so they're scheduled payments on corporations. And then there's also asset-backed securities, and we're going to talk about those today. Another subtype of these, and these fall under the treasuries, are TIPS, Treasury Inflation Protection Securities, and we dealt with those in another module, and we'll again talk about those a bit more in our module 10.2, or the next one. When you are evaluating a mutual fund, here are the several items that you will often evaluate and see listed. Yield to maturity. Yield to maturity, we've gone over the calculations of yield to maturity. It's a forward-looking measure. It looks at if all the scheduled payments are made, price of the bonds, what are the yields on those bonds. We talked about average maturity and duration. Average duration is a measure of how far in the future bond payments occur, and also is very highly related to the sensitivity of bond price to yield changes. Credit quality, and here you see a list of those: AAA, AA, single A, and all the way down to C's. Another way of putting those is investment grade, high yield, not classified. As we move down that list, investment grade, high yield, not classified, our risk of default go up, and hence our yield to maturity also goes up. Credit quality on many of the bonds that you will see are judged by rating agencies, Moody's, Standard & Poor's. Again, we covered that in another module. They rate these bonds. That's a basis for pricing these bonds. Expense ratio, or the expenses associated with the mutual fund, and then return before taxes. Returns before taxes give prior or historical performance of that bond fund and how have those returns performed. Two of the items that we often look at are on the previous slide are yield to maturity and return before taxes. They are somewhat closely related. Yield to maturity is a forward-looking measure. It's looking forward at how returns from that bond fund, what they will look like. Again, it's calculated given that all scheduled principal and coupon payments are made. It does not include a default risk explicitly. For example, it assumes that all bond payments will occur in the future. Returns before taxes are backward looking. It gives the returns in previous years, and you usually see it for 1 year, which would be 1 year in the past, 5 years, which is the average for 5 years in the past, and 10 years, which is the average of 10 years in the past. Again, that is backward looking. It will not necessarily match rankings of yield to maturity. So you can usually think about yield to maturity and understand the relationships that exist across bonds by looking at their duration, their risk, and whether they're tax exempt or not. The backward looking measure may not match those forward-looking measures because of actual realizations. What happened in the past, if we had municipal or corporate bonds go bankrupt in large chunks, then that won't match what our forward-looking measures say those returns will be. Tax exemptions exist for municipal bonds, so they're usually exempt, from federal taxes. They may be exempt from state taxes as well, and that depends on, the rules for the state. So each one of the 50 states will vary, and often states will give tax exemption for their own in-state bonds, but not out-of-state bonds. Tax exemption is important because it gives an advantage to municipal bonds, and you can see that by looking at an after-tax rate and the relationship between after-tax rates and before-tax rates. You see that in the equation there. After-tax rate equals the before-tax rate times 1 minus the marginal tax rate. So, I'm going to give you an example. If our before-tax rate is 3%, and we have a marginal tax rate of 15%, then in the blue there at the bottom you can see that we have an after-tax rate of 2.55%. So a 3% would equal 3% before tax rate would equal a 2.55% after-tax rate. Let's think of that in terms of advantage to a municipality, and take a municipal and a corporate bond that have exactly the same duration and exactly the same risk. If the corporate bond has a 3% rate of return, then the municipal bond can have a 2.55% rate of return and have the same equivalent returns to the individual. Tax exemption, as you would expect, it gives an advantage to municipal bonds, and it was specifically incorporated to give an advantage to municipalities and local governments in generating funds. Again, going back, we know that these are the typical yield relationships that exist for bonds. And again, if you look at a bond and compare it to another bond, you could generally find the same sort of yield relationships across those. If you increase the duration, you usually associate that with higher yields. Again, that's giving you the yield curve relationship. As duration increase, usually yields increase. That doesn't necessarily have to be the case. There's some instances of flat yield curves and decreasing yield curves. Second relationship, higher risk is associated with higher yields. That's almost a law of finance. Higher the risk, the higher the yield. Same as with the stock mutual funds. And then tax exemption is associated with lower yields. Again, tax exemption gives an advantage to the municipal bonds because of the tax exemption. Finally, we want to talk about asset-backed securities, and we haven't specifically addressed this type of a bond or debt instrument that can be held by individuals and others. But what asset-backed security is an interest in the fund, usually given as a stock holding, whose assets are backed by other assets, such as mortgages, student loans, and auto loans. We are going to be talking about this example in terms of mortgages because it's the single biggest market. And so I'm going to give you an example here of a mortgage-backed security. Here is an example of a mortgage-backed security. And in my example here, I have 10 loans in that. You can see those listed on the left-hand side of the screen. Each loan is worth $300,000, just making that for a simple comparison here, giving us a total loans in our mortgage-backed security of $3 million. So what this mortgage-backed security is an interest in those 10 loans, total $3 million. What the person then does is buys an interest in that mortgage-backed security. When they've bought that mortgage-backed security, they will get payments from the loans, each of the 10 loans. So you buy this mortgage-backed security, you get the payments from those loans. If any one of those loans defaults, then the payment does not happen. So what you have here is, if you bought a mortgage-backed security, is an interest in this example in a $3 million pool. You may own 300,000 of that, but then you would have an interest in each one of the 10 loans. The advantages of securitization are threefold. First is diversification. You actually reduce risk by holding an interest in a pool of loans than one loan individually. So, for example, let's take a bank that originates a loan of $300,000. It could hold that loan on its balance and take payments from that loan. It could reduce its risk, assuming that it could put that fund in a portfolio of other loans and buy an interest in that pool. So it would sell its loan mortgage to a mortgage-backed security, and then it would buy an interest in that loan pool. That would lower its interest rate, or lower its risk, assuming that the risk of all of those loans in that pool are the same as the risk of the pool or the loan that it sold. Second advantage is predictability. It's actually easier to predict the cash flow from a large number of loans than one specific loan, because once you have a large number of loans, the default rates are predictable. And there's mortgage-backed securities is also marketable. You can sell the shares of pools. There's a ready market for those shares. If you take a loan from the bank, what often happens is they sell that loan and buy mortgage-backed securities. The marketability, predictability, and diversification of those loans are highly valuable to lending institutions and other organizations. There are disadvantages to securitization. There are fees associated with the pooling of loans. Those are pool fees. You have to pay somebody to put the loans together and then make payments. And there's also a moral hazard issue. Individuals have the incentive to put the worst loans in a pool. So if you have a bank and they're trying to make a decision on 2 loans, they will often send the worst risk loan to the pool, because that way they get rid of that risk and keep the good, better loans on their own books. That causes underwriting, or the rules of putting loans into the pool, to be highly important when we're looking at determining the creditworthiness of a mortgage-backed security pool. The home mortgage market in the United States has 2 characteristics. One is most of home mortgages go through some securitization process, and the U.S. government is heavily involved in that securitization process. Here is an overview of home mortgage participants, and I'm going to go through the process of securitization here. So we're going to take, in the next several slides, block off and go through and discuss each area of this flow chart here. So we're going to go through that. You are going to see on the next 2 slides a list of the participants in this home mortgage market. Here again is a list of those participants. We have brokers who originate loans, the FDIC, which is a federal agency. It provides regulation for banks as well as depository insurance. Freddie Mac and Fannie Mae, the two items listed here, these are private organizations, but they do have agency status. They're a private charter, but they have the full faith and backing of the federal government. So their agency loans can often have a same interest rate or just a little bit higher than treasuries. So those are participants in the home mortgage loans market. And we'll go to the next slide that just again lists the participants. Ginnie Mae is another federal agency. We also have, and they differ from Freddie Mac and Fannie Mae in that they buy high-risk loans and then sell and insure the mortgage-backed securities that result. We have loans or the mortgages themselves. MBS is mortgage-backed securities. That's what we've talked about originally, and that's what you could buy, mortgage-backed securities. Banks originate and service loans. Ratings agencies assess the creditworthiness of the mortgage-backed securities, and poolers buy loans. So those are the participants, and now let's go through those charts and look at each one of the participants in more detail. Mortgage borrowers are the ones that are buying the houses and will need the loan. So mortgage borrowers are the ones that have the loan, and we're again talking about the area in the red blocks here. So mortgage borrowers are the ones for which loans are created. Those loans are often created through brokers. A broker is an independent person or agency. They aren't employed by necessarily any bank, but they create loans and then sell those loans to banks. The mortgage bankers in this slide buy loans, so the process here typically is that a mortgage borrower wants a loan, they go to a broker, the broker completes the loan papers and tries to sell that loan to a mortgage banker, and for that the brokers get a fee. The mortgage bankers then will sell the loans, and they typically sell the loans to poolers, and that is often Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac again are government agencies, so they're supervised and created by the U.S. government. One of their more important functions is to buy loans and then produce mortgage-backed securities from those loans. So the poolers take the loans and then they create the mortgage-backed securities. So a pooler, again, buys the loans, creates the mortgage-backed securities, and then will often oversee the receipts and payments from the mortgage-backed securities. The other place that loans can go to is Ginnie Mae. Ginnie Mae is a federal agency. This would be where high-risk loans go to. So high-risk loans would be sold to Ginnie Mae. Ginnie Mae would then provide an guarantee on those loans. So they guarantee losses at a certain percent. Ginnie Mae also produces mortgage-backed securities. The mortgage-backed securities are often rated by rating agencies, Standard & Poor's and Moody's, etc. They would rate the mortgage-backed securities, and those mortgage-backed securities then would be sold to agencies that would buy them. Typical agencies that buy mortgage-backed securities are Fannie Mae and Freddie Mac, the same individuals that pooled those loans. Often Freddie Mae and Fannie Mae in the past pooled the loans, and then they use their agency status to buy those back. Mortgage-backed securities can also be held by institutions such as mortgage bankers or individuals. So you could hold a mortgage-backed security. You will often hold that through a mutual fund. So here's the process. Again, we start out with mortgage borrowers, and they produce loans, we get mortgage-backed securities, and then you as an individual can hold those mortgage-backed securities as well as other institutions and government agencies. Again, as I stated on the previous slide, rating agencies often rate the mortgage-backed securities. And mortgage-backed securities were one of the prime items that caused the 2008 financial meltdown. One of the criticisms of that process was the mortgage-backed securities ratings agencies that rated those bonds. They had rated those agencies, or mortgage-backed securities, fairly highly, and have since come under scrutiny for not doing a very good job of rating those mortgage-backed securities. The government involvement in the home mortgage market is heavy. We have Ginnie Mae. Also, the U.S. government were the ones that created and regulated Fannie Mae and Freddie Mac. You could also say the federal government has a heavy involvement in the home mortgage market by interest rates it sets through the Federal Reserve. In any case, this market, the home mortgage market, is heavily influenced by federal regulation. To summarize here, what I have done is gone over the bond types, and I have also provided an overview of asset-backed securities with a particular example given for mortgage loans.